For 2 years, the entire world has been obsessed with one word: inflation. It was the thief in your wallet, the enemy at the grocery store, the political nightmare. But look at the data today. The dragon is wounded. Inflation is falling rapidly across the globe. So, why does the economy feel more dangerous now than when inflation was at 9%? Because the cure has become deadlier than the disease. The era of inflation is over. Welcome to the era of interest rates. This is why rates matter more than prices right now. We are transitioning from a cost of living crisis to a cost of debt crisis. Today, we dissect the silent killer lurking in your mortgage, your bank, and your government. To understand the danger, we must learn one formula: nominal rate minus inflation equals real rate. In 2022, inflation was high but rates were lower. Real rates were negative. Money was still loose. But now, inflation has dropped and rates stayed high. Real rates have skyrocketed into restrictive territory. This is the passive tightening. Even if central banks do nothing, policy gets tighter every day inflation falls. Positive real rates mean cash is expensive. Projects that made sense last year are now bankrupt. Central banks are trapped. If they cut rates to help growth, inflation might return. If they wait, something breaks. Monetary policy works with long and variable lags. Think of it like steering a Titanic. The pain you feel today is from the rate hikes of 18 months ago. The recent hikes haven't even hit yet. We have swallowed the medicine, but the side effects are just starting to kick in. The yield curve has been inverted for the longest time in history. This is the loudest recession warning possible. The economy looks fine on the surface, but underneath, the foundations are eroding from high borrowing costs. Where will the first crack appear? Let's look at the largest asset class in the world: housing. High interest rates haven't crashed home prices everywhere yet. Instead, they have frozen the market. Nobody wants to sell their 3% mortgage to buy a new house at 7%. This is the lock-in effect. Transaction volumes have collapsed. Real estate agents, mortgage brokers, and movers are out of work. But the real bomb is in commercial real estate. Offices are empty, and their loans are due. Developers cannot refinance at these rates. We are facing a trillion-dollar default cycle in skyscrapers. Who holds these bad loans? Small and regional banks, which leads us to the next domino. Remember March 2023. Banks failed not because of bad loans, but because of high interest rates. When rates go up, the value of old bonds goes down. Banks are sitting on massive unrealized losses. As long as rates stay high, bank balance sheets remain underwater. They stop lending to survive. This creates a credit crunch. Small businesses can't get loans to expand or pay payroll. A credit crunch always precedes a recession. It is the mechanism that turns financial stress into job losses. But banks are just the lenders. What about the borrowers? Enter the maturity wall. For a decade, zombie companies survived only because money was free. They profit nothing, they just borrow. Trillions of corporate debt is maturing in 2025. They must refinance, but the rate isn't 0% anymore. Moving from 1% interest to 6% interest increases debt service costs by 600%. This wipes out all profits. We will see a wave of corporate defaults, not because business is bad, but because the cost of capital is too high. This is the Darwinian cleanse. Only cash-rich companies will survive. The rest will be eaten by private equity. If you own stocks in companies with high debt, check their maturity dates now. It's a ticking time bomb. Inflation hurt your income. Interest rates are hurting your safety net. Savings are drying up. Credit card interest rates have hit all-time highs. Carrying a balance is now financial suicide. Auto loan delinquencies are rising. People are choosing between paying for their car or paying for food. The excess savings from the pandemic are gone. The consumer is running on fumes and credit. When consumers stop spending, the engine of the economy stops. This leads to the dreaded R word. But the biggest borrower isn't you or Amazon, it's the government, and they have a massive problem. The U.S. government has $34 trillion in debt. Every 1% hike adds billions to the interest bill. The U.S. now spends more on interest payments than on its entire military defense budget. To pay this interest, they must borrow more. This is the debt spiral, borrowing to pay the interest on borrowing. Bond markets are getting nervous. If investors demand higher yields to hold government debt, the system cracks. Governments have two choices: cut spending, political suicide, or print money, inflation returns. This forces central banks to eventually cut rates, not to save you, but to save the government from bankruptcy. The US dollar is the world's reserve currency. When the Fed hikes rates, it vacuums capital from the rest of the world. Investors sell euros, yen, and dong to buy dollars and get that high risk-free yield. This is the dollar wrecking ball. Look at Japan. They kept rates negative. The yen collapsed, making imports unbelievably expensive. For emerging markets, a strong dollar means imported inflation. Energy and food are priced in dollars. They are forced to hike their own rates to defend their currency, even if their domestic economy is weak. This creates a global feedback loop of tightening. The pressure is building on the entire international financial system. The most important number in finance is R star, the neutral rate where the economy is balanced. Nobody knows where it is. Central bankers are navigating by stars they cannot see. If they overshoot R star, they cause a depression. For a decade, we lived in ZIRP, zero interest rate policy. We thought free money was normal. It was an anomaly. Structural forces are pushing rates higher permanently. Deglobalization, green transition, and aging populations. Building redundant supply chains and green infrastructure is capital intensive. High demand for capital means high rates. Forget 0% mortgages. The new normal might be 3%, 4%, or even 5% as the baseline rate. History teaches us a brutal lesson. The 1970s. The Fed cut rates too soon and inflation roared back double. This stop-and-go policy caused a decade of stagflation. Powell is terrified of repeating this mistake. This is higher for longer. They will keep rates restrictive until something undeniably breaks. The market is addicted to the Fed pivot. Every hint of a cut sends stocks rallying, loosening financial conditions. This forces the Fed to talk tougher to counteract the market's optimism. It's a psychological war. So, how do you invest in this environment? Let's start with stocks. The rules have changed. High rates destroy long-duration assets like unprofitable tech. Their future earnings are worth less today. Focus on quality. Companies with strong balance sheets, low debt, and immediate cash flow. Small caps are highly sensitive to debt costs. Be extremely careful with the Russell 2000. For the first time in years, cash is a legitimate asset class. 5% risk-free is hard to beat. Real estate is a game of patience. Prices must adjust to the new reality of mortgage rates. If your rental yield is lower than your borrowing cost, you are losing money. The math is brutal. What about gold? Gold is the anti-dollar. When the Fed finally cuts and the dollar weakens, gold flies. Crypto is the ultimate long-duration asset. It loves liquidity. High rates are kryptonite. A pivot is rocket fuel. The key is diversification. Do not bet everything on one outcome. The range of possibilities is wide. We are witnessing the end of a 40-year cycle of falling interest rates that began in the 1980s. The rules of the game have changed. Strategies that worked during the Great Moderation will now fail. Capital is scarce, labor is scarce. The balance of power is shifting from capital owners to workers. Geopolitics is now a major economic driver. Friendshoring is inflationary but necessary for security. The next generation will face a world where money has a cost. This will force discipline and innovation. Inflation was the noise. Interest rates are the signal. Ignore the noise, focus on the signal. Pay down debt. Build cash reserves. Prepare for volatility. The silent killer is hunting the unprepared. The storm is here, but those who understand the mechanics will navigate it successfully. If this deep dive helped you see the bigger picture, smash the like button and subscribe for more. Thanks you.